We will commence this module by studying about the conceptual framework of financial accounting and integrated reporting. Financial reporting may be defined as communication of distributed financial statements and connected information from a business enterprise to third parties, that is external users including stakeholders, creditors, customers, governmental powers that be and the public. Financial Accounting Standards Board FASB USA has described that financial reporting contains not only the financial statements but also other resources of communication. News publications, management's forecast or other descriptions of its plans and expectations are examples of reports giving financial information. Financial statements include A. Balance sheet or statement of financial position. B. Income or earning statement. C. Statement of retained earning. D. Statement of other changes in owners or stockholders' equity. And E. Statement of changes in financial position, that is statement of sources and application of funds. Financial statements are often audited by independent accountants, auditors, for the purpose of enhancing confidence in their reliability. After studying this module, you shall be able to learn the evolution behind financial reporting, know about the IIRC, understand the guiding principles, know the relationship between integrated reporting and sustainable reporting. Now let us understand the evolution beyond financial reporting. A move to include non-financial performance in company reports has emerged, yet the focus of business reporting is still laid squarely on financial performance. There are some gaps felt by the various stakeholders in the aftermath of corporate scams, that what is portrayed before them is an incomplete picture and the corporate's role as responsible citizen of society is often neglected. It is felt that if these gaps are filled through reporting, companies would have a policy towards them. Over time, other types of corporate reporting have grown to fill these gaps, including corporate social responsibility, CSR reporting, carbon or environmental reporting, sustainability reporting, and now integrated reporting. These additional reports disclose non-financial information about environmental, social, and governance ESG strategies and practices. And perhaps more importantly, point towards extra material risk for a company. For example, British Petroleum, Coca-Cola and other companies are handled environmental risks that must be significant downward impacts on their share prices because investors were simply unaware of those risks and those risks had not been discussed in external reports. During the 1990s, some corporations started to freely produce non-financial reports reproducing investor calls for more informed corporate release. The content of these reports varies considerably, but in general, it contains information regarding environmental, social and or economic performance in a printed format. Integrated reporting, that is representation of the financial and non-financial presentation of a company in a single report, doesn't only mean merging financial and sustainability reports into one report. Its true implication is to connect sustainability approach to business approach and help the company and its investors recognize the non-financial priority areas. Integrated reporting demonstrates the linkages between an organization's approach, governance and financial presentation and the social, environmental and economic context within which it operates. The first integrated report was issued by Novozymes, a Danish pharmaceutical company, in 2002. In 2006, EC Directive 2006/46 mandated that all publicly listed companies in Europe had to include a corporate governance statement in their annual report. In 2010, the filing of integrated reports becomes mandatory for the companies listed at the Johannesburg Stock Exchange. The days of having standalone sustainability plan are gone, and we are increasingly nearsighted this incorporated into the essential strategy of business. Integrated reporting, as proposed by the IIRC, promotes a more consistent and efficient approach to corporate recording and aims to improve the value of information available to providers of financial capital to enable to a more efficient and productive distribution of capital. We shall now understand about the IIRC. The International Integrated Reporting Council (IIRC) is a global coalition of regulators, investors, companies, standard setters, the accounting profession and NGOs. Together, this coalition shares the view that communication about value creation should be the next step in the evolution of corporate recording. The international framework has been developed to meet this need and provide a foundation for the future. The IIR sees long-term vision in a world in which integrated thinking is embedded within mainstream business practice in the public and private sectors, facilitated by integrated reporting as the corporate reporting norm. The cycle of integrated thinking and reporting, resulting in efficient and productive capital allocation, will act as a force for financial stability and sustainability. An incorporated report describes how an organization generates value over time. Value is not created by or within an organization alone. It is influenced by the exterior environment, created over the relationships with stakeholders, dependent on different resources. An incorporated report therefore aims to provide insight about the external environment that affects an organization, the resources and the relationships used and affected by the organization, which are referred to collectively in this framework as the capitals and are categorized as financial, manufactured, intellectual, human, social and relationship and natural. How the organization interrelates with the exterior environment and the capitals to generate value over the short, medium and long term. An integrated information should show a general picture of the arrangement, interrelatedness and needs between the features that affect the government's ability to create value over time. In this value creation process, at the core of the organization is its commercial model, which appeals on various resources as inputs and through its business undertakings convert them to outputs, products, services, byproducts and waste. The organization's undertaking and its output lead to consequences in terms of things on the capital, the capacity of the business idle to adapt to modifications, for example, in the obtainability, quality and affordability of inputs can affect the organization's longer term practicability. Next, know about the guiding principles. The following guiding principles reinforce the preparation of an incorporated report, informing the at ease of the report and how information is obtainable. Strategic focus and future orientation. An integrated report must provide understanding into the organization's approach and how it narrates to the organization's skill to produce value in the short, medium and long term and to its use of and belongings on the capitals. Connectivity of information. An integrated report should show a complete picture of the grouping, interrelatedness and dependentness between the aspects that affect the organization's capacity to create importance over time. Shareholder relationships. An integrated report should provide understanding into the nature and feature of the organization's association with its key shareholders, including how and to what level the organization understands, takes into account and responds to their legitimate needs and interest. Materiality. An integrated report should reveal statistics about materials that practically affect the administration's ability to generate value over the short, medium and long term. Conciseness. An integrated report should be short or concise. Reliability and completeness. An integrated report should include all material, both positive and negative, in a well adjusted way and without measurable error. Consistency and comparability. The information in an integrated report should be obtainable A. on a basis that is consistent over time, and B. in a way that enables comparison with other organizations to the extent it is material to the organization's own ability to create value over time. We shall now understand the relationship between integrated reporting and sustainability reporting. Sustainability reporting is a process that assists organizations in setting goals, measuring performance and management change towards a maintainable global reduced, one that associations long-term profitability with social accountability and environmental care. Sustainability reporting, mainly through but not limited to a sustainability report, is the key platform for communicating the organization's economic, environmental, social and governance presentation reflecting positive and negative impacts. Integrated reporting is a developing and growing trend in business reporting, which in general aims mainly to offer an organization's workers of financial capital with an integrated representation of the key factors that are material to its present and future value creation. Integrated reporters build on sustainability reporting basics and disclosures in preparing their integrated report. From side to side the integrated report, an organization provides a short communication about how its approach, governance, presentation and prospects lead to the creation of value over time. Therefore, the integrated report is not intended to be an extract of the traditional annual report nor an arrangement of the annual financial statements and the sustainability report. However, the integrated report interrelates with other information and communications by making orientation to additional in-depth information that is provided together. Although the purposes of sustainability reporting and integrated reporting may be changed, sustainability reporting is an essential element of integrated reporting. Sustainability reporting think through the significance of sustainability to an organization and also addresses sustainability significance and key topics, focusing on the impact of sustainability trends, risk and prospects on the long-term prospects and financial performance of the organization. Sustainability reporting is important to an organization's integrated thoughts and reporting process in providing input into the organization's proof of identity of its material issues, its strategic objectives and the valuation of its ability to attain those objectives and create value over time. Many organizations that use the GRI guidelines have started experimenting in the field of integrated reporting despite the absence of an internationally accepted definition and framework. Let us now recapitulate what we have learned so far. Financial reporting may be defined as communication of published financial statements and related information from a business enterprise to third parties, that is external users including shareholders, creditors, customers, governmental authorities and the public. Reports disclose non-financial information about environmental, social and governance strategies and practices, and perhaps more importantly point towards additional material risk for a company. IIRC promotes a more cohesive and efficient approach to corporate reporting and aims to improve the quality of information available to providers of financial capital to enable to a more efficient and productive allocation of capital. Guiding principles underpin the preparation of an integrated report, informing the content of the report and how information is presented. Strategic focus and future orientation, connectivity of information, materiality and conciseness. Sustainability reporting, mainly through but not limited to a sustainability report, is a key platform for communicating the organization's economic, environmental, social and governance performance, reflecting positive and negative impacts. Thank you.